All right, welcome everybody. Welcome to the show. This is our market update brought to you by Richmond Rhea, Fresh Start, and Finance of America. So I wanted to get on here and welcome everybody. This show specifically, I want to make sure everybody knows that is going to be interactive. So you're more than welcome to participate with some questions, answers, comments, and so forth. If you have deal flow, please let us know, and I'll get you over here a link in just a second that you can tap into. But wanted to welcome my partner in crime, and the one that helps me out with all our market updates. Where's my buddy? There she is. How are
Right
you,
here.
Lindy?
Good. How
All
are you?
right, welcome, ma'am. It's Tuesday
Good.
again.
Thank you. Oh, it is Tuesday again. And you know what I was thinking yesterday? It was a holiday, right? And I was thinking, oh no, tomorrow's Tuesday. So yeah, it snuck up on me really fast this week.
We love those great holiday weekends, right? But it did
Yes,
sneak up on us. This
it
one.
does sneak up on you. Yeah, it does.
Well, tell me, so eventful week, you think, from last week to this week?
Unemployment comes out every Wednesday. Mortgage app numbers come out every Thursday. I do have a couple of meetings this week, later this afternoon into tomorrow, on some products coming back. So that's good. Some bond programs are starting to come back. So that's positive news. So I definitely think we're starting to see some positive things come out. Yeah. I know people are out and about. I mean, the news was crazy with people, on beaches and lakes and things like that. So people are definitely bored and they're getting out. So there's positive there.
Right. And I got to tell you, from last week to this week, from a bunch of new listings and everything else, we actually had a lot more go under contract. We had 4 more deals go under contract, this week from last Tuesday to this Tuesday. So really exciting stuff. Movement's back, and everybody's has still got the confidence in wanting to get that home ownership, right? So.
Yep. I agree with you. Right now I've got 6 people that are pre-approved, meaning they've already sent me pay stubs, bank statements, W-2s. I have all their documents and I've put them through the system and they have a pre-approval and they're out shopping for houses. I have some of them have put anywhere from, 2 to 8 different offers in. And not getting, it's just so competitive out there. Inventory is so low, and we'll talk about that. It's so competitive. And so this weekend I had 2 get their offers. One had to way overbid, and the property was not in good shape. So I'm sure there wasn't as much competition. So they're starting to get, I don't know if it was timing coincidence, they got theirs after all the offers that they made, or I don't know, but you're right. There absolutely is more activity going on out there with listings and buyers. Yep. Absolutely.
Well, so without further ado, what kind of good market update we're going to do today?
So today, I thought we would have some more time today, right? So what I thought, and sorry, I keep looking over here because your face is over here, but my screen is over here. So what I thought we would do today is let's spend a little more time maybe on a lot of what I'm hearing from our investors that you and I talk to on a regular basis is the anticipation of all the foreclosures, the anticipation of prices dropping so low, because that's what happened in 2008 at our last recession. I think so many of us have in our brain what happened last time is going to happen again this time. And you and I have had these conversations where I'm not so sure that's going to be the case. So what I thought I would do is maybe go a little higher level. I don't have as much weekly stats in this in these slides as I normally would, but it's maybe more of a high level. And let's talk about some similarities and differences between the past recessions and this one, so that it might help our brain have appropriate expectations of maybe what we're going to see, right?
Great idea.
Okay.
Yeah, that's a great idea. Perfect.
Right. And again, no crystal ball. You and I don't know anything of what's going to happen, right? We don't know anything, but let's take a look at what's the same and what's different, and maybe that helps educate ourselves. How about that?
That's great. And then just to remind everybody, again, if you have any questions or comments, again, please post them down below here. So that way we'll get to them and bring them up and answer them as they come up. Lindy wants to make sure that this is an interactive call. And if you have any questions, please post them up in the comment section here, so that way we can get that across to you. So without further ado, Lindy, let me bring up your slides here. Wow.
And I do really want you guys to ask us questions. I want to know, do you like the information I'm giving you guys every week? Would you like to see more about I don't know, whatever, right? Would you like to see more about GDP or unemployment, or I don't know, whatever the topic is that you guys want to see? Mo and I want this is for the benefit of you. So we want you guys to tell us, what do you like? What do you don't like? Ask us questions. I mean, I don't know that I'll know the answer, but ask. Let's see. If I don't know, I'll go find out for you.
The professionals are in, so come on down.
All right, let's get going. Okay, and I have to remember, so because this is a slightly longer presentation, I made more notes, so I have to remember to look at my notes slide too. So don't let me get so excited and distracted that
I'll watch the notes and the questions as they pop in.
Perfect.
So when they do, I'll relay them to you. Is that good?
That is perfect. Thank you. Yes.
All right, here we go.
All righty. So what I would like to talk about today. Where's my little button? There it is. So we're going to talk about, are we in a recession? Don't get me started on that one. Are we in a recession? Is it going to be like 2008? What about all these job losses that we're hearing about? What's going to happen with mortgage rates? And then what's the good news out of this whole, you and I are silver lining people. So what's the good news for us, right?
Right.
All right. So the question is, are we in a recession? So the definition of a recession is, I got to keep up with my slides. Sorry, I'm looking at my notes to make sure I don't forget. I'm not so practiced at this. All right, so are we in a recession is the question. Absolutely we are. No doubt we are. The definition of a recession is not 2 consecutive quarters of negative GDP, which a lot of people think about, but it is a broad slowdown of economic activity across many sectors that lasts for more than a few months. So obviously we know we're in a recession, right? Yeah. Usually this is called when the labor market peaks. So this is very important to know when it started so that we can know when, in theory, it's going to end, right? So when we hear people say, oh, it's going to last 12 months, 18 months, 24 months, whatever that number is, if we don't know when it started, we don't know when it's going to end. So it is very important to know when it started. So if we take a look here at, because usually this is called when the labor market peaks, right? So if the labor market peaked right here, and this is 07, 08. This is the last great recession or real estate recession, right? So if it peaked here and then it dipped down here, this was the official start of the recession. We already know. So what's different about this recession is we know so much more information now from past experiences, but also technology. We know so much more information now than we have in years past, right? That we could kind of get to the answer a little quicker. So here we know that our official start of our recession was February of 2020. It might be March 2020, but we know it was somewhere between the end of February and the beginning of March was the official start of our recession. So if they're calling it, they being the smarter people than you or I, right? If they're calling it at 12, 18, 24 months. We know it started in March of 2020. So we know we're already 2 months into it, right? So it is helpful to know that.
Yep,
something else that we need to pay attention to is a recession does not mean a housing crisis, right? So they're apples and oranges. They can be 2 completely different things. So the big fear is that a lot of people think that this recession is a housing crisis, but that's not necessarily the case. So I'm going to read you guys a quote here. And I'm going to read it for all the people that are driving in their car. Maybe we're not driving in our cars as much anymore, but anyone who's listening and not watching. The quote says, with the exception of 2 recessions, the Great Recession from 7 to 9 and the Gulf War recession from 90 to 91, no other recessions have impacted the U.S. housing market, according to Freddie Mac. So think about that. When we talk about a recession, it's important to note that only the last 2 of 5 recessions actually saw a retraction in the housing market. The rest saw price appreciation. Think about that.
Yeah.
So as we digest that, yeah. I mean, think about that. We have in our brain, because I think the last one in 07, 08, so it was the last one, it also had such a heavy impact on all of us that would be listening to this call, right? Right. I think we're connecting the dots, and I want us to start disconnecting those dots.
Yes. That's a great point, because it's not going to mean necessarily housing is going to take a hit. So yeah,
that's right.
I agree.
That's right. And in fact, housing can sometimes help us recover from a recession, which is what I think is going to happen this time. Again, silver lining, right?
Yes,
All right.
that's right.
So yeah, I mean, think about that. This might be the, last time in 07 and 08, I, worked for a lender, obviously. And of course it was our fault. We were throwing money at people. If you had a heartbreak beat, we would give you a loan, and the crash, everything that happened, and it was all our fault. We were the big bad wolf, right? This time, we actually might come out to be a small hero in it, right?
The good guys.
Right. Yeah, that's so easy. Right. So let's take a look. This chart here. Right. I'll take. Hey, if I can not be the bad guy this time, I will absolutely take it. So when we take a look at this chart here, it talks about home price changes during the last 5 recessions. So the 1980 recession, the 1981, 91, 01, and then 2008, which is the one I think we all have stuck in our head. So here's the documentation to back up the quote that we just were talking about. We had a great appreciation in 80 and 81, right? 91, we had a slight decrease, a slight depreciation for just a short time period. And then the 2000s with the dot-com and the 9/11 recession, we had appreciation up. And then the mortgage meltdown in 08 was an anomaly because it was caused by the mortgage market, just like we talked about. All right, so the next question is this going to be like 08? I think that's what's on everyone's mind, right? Or that's what everyone is thinking. They're automatically linking the two, right?
That's right.
So I'm going to read this quote again for all of you guys who are listening. So many, myself included, Mo, I assume we can include you in the many as well. That's so many, like a lot of us, right? Many still bear scars from the Great Recession and may expect the housing market to follow a similar trajectory in response to the coronavirus outbreak. But there are distinct differences that indicate the housing market may follow a much different path this time. So while housing led us into the recession 08 and 09, this time it may be poised to bring us out of it. So to what you and I were just talking about.
Yeah.
All right. So my next slide talks about during the mortgage crash, right? So this is the housing and mortgage crash annual home price depreciation. So the we saw the S&P 500 correction of 50%, and then we saw depreciation pretty heavy through 7, 8, and 9. But the good news is this time it's different. So this time, so what 9/11 has in common with what happened today, what is happening today, is that this shock also generated fear, angst, anxiety among the general public. People avoided crowds, right? Remember 9/11? We weren't going out. Yeah. We weren't getting on planes, right? Same thing. People avoided crowds then as they believed another terrorist attack was going to happen or was coming. And we're acting the same way today to avoid getting sick. I mean, all for good reason, right? Yeah. But a lot of similarities between more so the behavior that's happened after 9/11 with the behavior that's happening now. It's much more of a fear. The same parts of the economy are under pressure. Airline, leisure, hospitality, restaurants, entertainment, right? All the same things that were happening after 9/11 because of that fear. They're the same sectors that are being affected. So consumer discretionary services in general after 9/11, and it's the exact same thing now. Remember, consumer spending accounts for 70% of our economy, 70% of the GDP. So when we're not out spending money, we're not traveling, we're not doing living the life that Americans normally live, that has a great impact. We're not spending money, so the municipalities aren't getting the tax revenue, from retail sales, from restaurant tax,
retail sales, right?
Yep. All of those things. So these things are very similar to what happened after 9/11, so much more than the recession, the housing crisis.
Yes. Yeah. Great points.
The other thing too I want to mention is that the housing crisis last time, it took us 10 months to get to the same lows that it took us 2 weeks this time. So again, this is much more like after 9/11, a national crisis, right? This is a natural disaster. This is like, if some bad storm covered the whole entire United States, right? It's happening nationally all at one time, but it was all of a sudden thing. Whereas the last recession in 07 and 08, it took us 10 months to get down there. And you don't know when you're at the bottom until months later, and you can look back and say, oh, that was the bottom, right? So have we hit the bottom? A lot of people think we have. We won't know for a few more months at least. But it took us, we went down so fast this time compared to the 7, 8. I mean, it was a plummet, right? All right. So post.com, I don't know how many of you guys remember post.com. I do. And the 9/11 crash, the annual home appreciation during this time period. So here's what we saw during the .com and the post 9/11 crash. It wasn't something that happened over time. It was something that happened immediately and affected people's sense of fear. So even though we saw the S&P correction here, -45, that's the correction, just like we saw in current times, you can see that we had great appreciation for years to follow. So again, different. Now let's take a look at the run up to the '08 crash versus the run up to where we are now. Let's take a look at that next. Let me just scroll to my next slide. Sorry, I'm clicking it in 2 different places so I can pay attention to my notes. All right, so here is our, so think about this. Leading up to the crash, the housing crash in '07 and '08, look, we had 8.6, 6.5, 8.5, 12.5. Almost 11.5% appreciation leading up to it. Do you remember back in 6, 7, 5, 6, 7, right? Remember California? And we would hear about the price appreciation, the value appreciation in places like California, New York City, big markets like that, and how crazy, the prices had gone, right? It was just craziness. So the last 6 years now, we've not had that kind of craziness, right? So last 6 years leading up to coronavirus, 4.4, 5.2, 5.5, 6.5. I mean, that is half of what it was, almost half of what it was during the last crash. So we don't have a bubble to pop. We don't have such appreciation leading up to the crisis that we're in now compared to the crisis that we were in last time. All right, so let me read my notes because I totally skipped over them. So let's see. As you can see, the run up in the housing crisis, we had inflated and overinflated in some markets, in overheated markets for annual home price appreciation. And that's because coming out of the .com era, people were fearful of putting their market back in the stock market because of that retraction. That they had chosen housing as their next investment vehicle versus the stock market. So it makes sense, right, why we did what we did. Anytime you have an investment vehicle that is overheated, a run-up, think oil, think gold, it becomes overbought and needs to have a correction. That was the bubble that popped, right? So as you can see, that's not what we have today. We are very close to that 4% trend line that we've had if you average it out over the past 50 years. So we're much more normalized and we're much more averaging now than we were leading up to the last crisis. So there's fear that we might be going back into another housing crisis. And here is some information or statistics on why I'm not sure that's going to be the case.
Right.
So if you guys remember, those of you who lived through the 5, 6, 7, that time period, mortgage credit availability. So back in '03 to '07, you could get a loan. I mean, were you breathing? Did you have a pulse? Did you have, it was pretty simple. Everyone could get a loan. Remember, we had those loans. You could get a HELOC up to 125% of your loan to value. You could get 110%. I mean, it was just crazy how easy it was to get a loan, right? So everyone thought that housing was going to continue like this forever and ever. The availability of credit was 4 times higher. So here's our index number. The availability of credit was 4 times higher back then than it is now. And for those who buy homes qualify for them. Those who can afford pay for them. In fact, until this crisis, the amount of people that were late or foreclosure was the lowest it's been in 60 years. 90-day delinquency rates as of 2 weeks ago were 1.2%, extremely low, right? We had a very healthy economy and we had great mortgage stability. So it is much harder to get a mortgage today, 4 times right, than it was back in '06, if you just look at this index number. So if you're getting a mortgage today, the theory is your ability to repay that mortgage is much greater and stronger than it was back in '06. All right, so let me move to the next slide. Again, sorry, moving 2 different ones. All right, so So, as we talk about speculation and we touched on credit availability, right? We talked about the stock market. We talked about that index of how much it's harder to get a mortgage now than it was before. Doing loans doing loans to the 100% LTV and home equity lines up to 125. That's what it was then. It is absolutely not like that now. Like a HELOC in today's market, if you can get one on a home equity line of credit, which is HELOC, you would be limited to an 80% loan to value. Whereas back then you could go up to 120, 110, 125% on a HELOC, right, which was getting people upside down. Remember? Right. People would just walk away. So I lost my job. There was this thing called forbearance, wasn't like it is today, right? So I lost my job. I can't afford my mortgage payment because I probably didn't really qualify for it to begin with. And then I pulled out a HELOC and now I owe more on my house than what it's worth. I lost my job. I can't make my payment. I'm just going to walk away. We don't have that. And Mo, you and I talked about this the other day. We don't have that today. And we'll get into equity in the next slide. But it's much harder to pull money out. So as you can see by this slide, look in 05, 6, and 7, we pulled out as a nation, as an economy, we pulled out $824 billion in equity then. Now we're only able to pull out a fourth of that. In 17, 18, and 19, we've only been able to pull out $232 billion.
Wow.
So let me look at my notes. So think about all the people who were completely upside down. We talked about that because they cashed out all the equity in their house. You were thinking about a country that didn't have a lot of equity in their homes. We had a lot of home ownership, but we didn't have a lot of equity in the homes that we owned. Think about that. This has not been the case for the last few years. People learned their lesson and also got harder to do, right? We as lenders learned the lesson. Government learned the lesson and put restrictions on us, right? They put train wheels back on us, right? So when you have no equity position, what did you, if you didn't have any equity in your house, would you have to lose? So you would just walk away and it would go into foreclosure. So take a look at where we are today. So Americans are sitting on a tremendous amount of equity. And to me, this is still a little hard. This slide is still a little hard to believe. I believe the stats. I believe it's true, all of that. But when you look at it, you think, wow, really? It is. So Americans are sitting on a tremendous amount of equity, right? 53.8% of all homes in America have at least 50% equity. Think about that.
That's beautiful. That's
half
great.
Of all the homes have 50% equity. That's crazy, right? 37% of all homes are owned free and clear, and then 26.7, so let's call it 27% of the mortgaged homes have at least 50% equity. So I do think some of this is attributed to the baby boomers, right? They're a little more conservative than my generation, right? We're both together way more conservative than the next generation after me, right? So people who kept their house just kept building up equity in it. I know we live longer in houses. In any one given house, we live longer. It used to be an average of 3 to 5 years a first-time home buyer lived in their house, and now it's 5 to 7 years. I imagine all of this, when people not moving around, it'll elongate just a little more, right? So the longer you live in a house, the more equity you build up. But 37% of homes are owned free and clear. Think about that.
Beautiful.
That's a third, right? That's a ton.
That's a lot.
Is it? All right, so let's talk about all those job losses. Realize this is some negative and we don't like negative news, but I want you guys to be informed. I want you to be educated about what's going on. So let's talk about those job losses. And it depends on who you talk about as to what number you get. Right. You guys can, right? You hear on the news, I sometimes hear on the news, oh, it was 14%. Oh, it was 19%. Okay, well, what numbers are you looking at? Like, are you looking at an all-in number? Like anyone and everyone, or it's an all-in number? That's called a UI. Is it the all-in number? If so, we're in the mid-20s right now. Again, unemployment comes out every Wednesday, so we'll know tomorrow. And it had been trending at like 3 million, 4 million, 6 million, 4 million, 3 million. I think last week we were back down to 2 million. Now, that's still crazy because normalized in a normal world, we're at 200,000. And now we're saying, oh, good, we're down to 2 million. It's still a horrible thing. It's still a crazy number. So when you take a look at, so back to the point of, it depends on who you're listening to and what data they're putting in their number. Depends on, if you adjust for not including furloughed people, which 80% of furloughed people believe they're going to be back to work in the next 3 weeks. So if you don't count those people in, then we're somewhere in the 7% range. If you count all in, furloughed, self-employed, everyone in the whole kitchen sink, then you're somewhere, 24. They think, and they being the people smarter than you and I, right? They think that the truth is somewhere in the middle, that we're really at a more honest unemployment rate of about 15% or so. Yeah. They, again, being the people smarter than we, think that we'll be in that double-digit range from now till the end of the year, and that 15% might be that range that we're in. So unemployment is still going to be absolutely horrible. It is. It is absolutely a negative number, but it is important because it shows us a trend, and a trend is very important to watch when you're talking economics, right? All right, so let's talk about this alphabet soup, Mo, that you and I talk about often, right? Is it the V? Is it the U? Is it the W? Is it the Nike swish? Is it the check mark? I mean, all these things that we've talked about over the past. Can you believe we're in week 11?
I know.
So all of
I know, it's flown by now.
Isn't it? I mean, on one hand, it feels like it's been forever. Like if you think about, oh my God, I've been trapped in my house, that feels like forever. But when you think about, wow, week 11, gosh, a whole lot of crap happened in 11 weeks, right? That's a lot of stuff. Can I say crap? I don't know if I can say crap on national TV. I don't know if I can say crap. I always tell my children, never talk to the news, because you never look like an intelligent person, right? When you never talk to the news. Okay. I digress. Sorry. All right. So let's talk about our GDP. And I want to stress to you guys, I know this looks like a V. No one says it's going to be a V. Absolutely no one says it's going to be a V. I think certain sectors I have heard would be a V. Maybe real estate and lending might be one of those that rebounds faster, that is healthier. It's absolutely not going to be a V for a lot of sectors. The transportation, the hospitality, the restaurants, barber shops. My guy, not that I go to the barber shop, but my guy who takes care of me, he can only see half the people at a time now from what he's used to seeing. Right. So his income right there, he was not working for X amount of months, and now all of a sudden he's only at 50% of his income. So make sure you tip your people that take care of you. Make sure you tip them well, right? All right, so let's talk about this alphabet soup that we talk about. So when you look at this in a percentage, it does look like a check mark, right? And when you look at this in a dollar amount, though, it looks a lot more sharp going down and more elongated coming up. And so you and I, Mo, have talked about that. People have talked about a W, right? So it depends. Again, the unemployment, same thing with the GDP. How are you looking at it? And the chart that you're looking at, is it a percentage or is it a dollar amount? Because the charts look very different, shockingly.
That's a great point, because that's the opinions that they're showing. Because if it's a dollar figure, we've got that long, stretch
elongated.
Out because of what's been affected, right? So,
right. Exactly. Yep. So when you see them side by side, and I can show that maybe in one of our future calls, when you see them side by side, the percentage, like this one, it is more like a V. Like, to me, this looks like a wider V, right? But when you look at in a dollar amount, it takes a lot longer. It's a lot flatter of a line over here on the right-hand side.
Yeah, that's right.
Yep. All right. So let me look at my notes. So this is the one thing we've learned through history. This is very good. I'm glad I wrote my notes here. Reaction of the government controls the speed of recovery. Think about that. Reaction of the government controls the speed of recovery. So the reason we know this is during the Great Depression, the government did absolutely nothing, and it lasted years. Did you know, and I had no idea about this, Mo, did you know that unemployment insurance wasn't invented until after the Great Depression?
I heard that just recently. Yeah. I don't know.
Crazy, right?
Or somebody else, maybe.
Might have been me. So, the Great Depression was 1929, right? And I think it was 1932, that the government invented unemployment insurance. And then think about this: it took 2 to 3 years for you to get your money.
Yeah.
So, we're complaining now, and I think we absolutely have a right to, but people are complaining, oh, it's taking me 3 weeks. 3 weeks? It took like 2 to 3 years, back then. So during the Great Depression, the government didn't do anything, right? Not for a very long time. During the Great Recession, they started doing a lot, but they started doing a lot of things late. So again, we didn't realize that we were at the bottom until a long time after, and it took us 10 months to get to the bottom. So it took the government a long time to say, oh no, we better do something. And oh no, what do we do, right? It took us a lot longer to do that. So this time the government jumped in very hard, very fast, very heavy to make sure that we don't go through another depression. The financial policy that has come out for this crisis that we're currently in is absolutely unprecedented. I mean, we have things now that we didn't have before. We have the forbearance. We have the moratorium on evictions and foreclosures. We have the stimulus check. We have the PPP. There's all these things that we have, and it might not feel sometimes like it was super fast, but in comparison to previous crises, this time it has happened super fast.
Yeah.
Super fast. So keep in mind the reaction of the government controls the recovery speed. Very important. All right, moving on to my next slide. There we go. All right, so let's talk about unemployment rate projections. And this is by Goldman Sachs. Again, people that are way smarter than me. So this shows the chart. It needs to be a little more updated because obviously we're a little higher right now in unemployment than we thought when I made this chart a couple of weeks ago. But certainly, and again, it depends. Are we talking, is it an all-in kitchen sink unemployment number? Does it include all the furlough? Does it include all the self-employed? So I'm going to pick 15% for the rest of this year.
Or is that the between number that we were talking about?
It is. Yes.
The 25 versus, okay.
It is. Yes. So again, I'm just telling you, I know I have a margin of error on either side. I'm just going to pluck right in the middle at the double digit and go 15%. It's also projected that we will look and feel like 15% for the rest of this year. So let's just say 2020 ends up averaging out to be 15% unemployment, right? Mm-hmm. Let me just look at the key fact. But the key fact here is that we were going to recover quickly. So we're not going to stay at a 15% for 2 or 3 years. It's not going to be stretched out. It's going to recover. And I know 6 to 8% doesn't sound great for unemployment, but compared to 15, I'll take it any day, right?
That's right.
Right?
Exactly.
So we're going to show another graph later of the Depression and the Great Recession and how long the unemployment numbers held. But here you can see by 2021, we're already dropping 6 to 8% to 6 to 8%, and then 5%, and then 4%. So technically, it is a quick rebound, even from the unemployment numbers. So, even if that 4% is a little aggressive and we stay over here, I was pointing, you can't see it, and we stay over here at 6% versus 4%, so much better than 15, 20%, right?
Yeah.
So it's still a positive. All right. So let's look at this slide. Unemployment rates and home sales. They do not have a direct relationship. So they kind of sort of did in the recession, right? It felt like they did, right? Unemployment went up, home sales went down, foreclosures went up. We thought it was all directly related, but that was that recession. This is this recession. So take a look at the bars that we have here. Those are existing home sales. And then look at the unemployment rate.
Wow. Yeah.
So not connected.
No, not at all. Yeah.
Kind of, sort of the opposite, but not really, right? But definitely not connected. They don't parallel at all. All right, let's take a look at our. Can we go back 1 second?
No, that's great.
You good?
That's
okay.
Yeah.
All right, so here's what I said we were going to talk about in a second. So current unemployment rates compared to the past financial crises, right? Did I spell that right? A crises? So during the Great Recession, I'm a horrible speller. I'm left-handed. We can't spell. So that's right. So during the Great Depression, 1930s through 35, we had, 8.7, still bad, but for back then was much more normalized. But look, it went from 15% to 23, 24, 21, 20. So look at that. So almost 16% for 4 years in a row. Then for 4 years, you were over 20% for unemployment. That's crazy, right? Take a look at the Great Recession, our last housing crisis, right? So again, you're close to darn close to 10%. 9.9, if you ask me, is rounded up to 10%. 9.3, 8.5. And take a look at the longevity, I guess is what I'm trying to show you here. The longevity went for years. Now take a look at this one. This is what we're in right now. So let's say it gets to 15. Let's say it was even 20%, right? The projection for next year is back down to 6 to 8 and then back down to normalized. So yes, really bad, but really bad for a short time period in comparison to the Great Recession and the Great Depression.
Yeah. And, simply, I think it's just simply because of the fact of, it's just a matter of a restart is what we're experiencing, right?
Yeah.
Because our economy is not anywhere near what it was in that Great Recession, right? So that's why that was more of the financial. This is why it's really great that you've done this layout, Lindy, because really what this really helps show the differences and the similarities in a lot of cases. Yeah, This is great.
And I think so many people think that there's so many. I actually think there's more differences than similarities. And you and I can have that conversation and talk about, well, this is different, this is different versus this is the same. I think there's actually more differences than there are similarities, which is when I want to show you guys, or I want us to make sure we have accurate or appropriate expectations of what's going to happen going forward. And again, Mo, you and I don't know what's going to happen. We don't have a crystal ball. We wouldn't be, we'd be lottery winners if we did, right? So we don't know, but there's a lot of differences and there's a lot more positive, than there could be, right?
Well, like compared to last time around. We both don't have a crystal ball, so we don't know what the future is going to look like. But based on all the signs of what's here, that's what's exciting to see is housing wise, which is driving us. That's what's going to, I think, help us recover, is what we talked about, right? A lot.
Absolutely. Absolutely. And on that note, let me show you this one. And on that note, let's talk about interest rates. So we were already having fun, positive news, right? Let's have a little more fun. All right, so let's talk about interest rates. Let me just make sure I'm checking my notes here. Hold on. I guess it helps if I can find my mouse, doesn't it? All right, so here's you guys can tell I don't do this I'm not a professional, whatever person, right? Okay, so let's take a look at interest rates. So mortgage rates from Freddie Mac. So Freddie Mac, Fannie Mae, Freddie Mac, those are conventional loans, right? So Freddie is showing us, it's the source that I got this information from, is Freddie Mac. So 30-year fixed rate from February to April of just this year, right? So a very short window, right? We're just talking 2 months. So from February 1 to April 2nd. And so this is a little old, right? But it's kind of sort of still the same. We had a lot of volatility. So you can think, oh, no big deal, Lindy. I mean, 3.95 to 3.33, unless it was your own mortgage, you're thinking, oh, no big deal, right? But look at the torment that we had to go through, right? And you don't know it's going to end up here when you're over here, right? You don't know that's where it's going to end up, right? So that is a lot of volatility. And if you guys don't feel that that's a lot of volatility, I promise you, I'm telling you. That's a lot of volatility.
Oh my gosh.
When you're looking at something day to day, that's a lot of volatility. All right, let's take a look at the next slide. So the next slide, even more volatility. So if you take a look from January 2016, so 4 years ago, right? 3.97, 3.33. So now look at these big spikes. So look at all that volatility there.
Yeah.
Right. So now the big spikes that you see were at the end of 2018. That spike gave you a rate around 5%. Let me find my date. 2018, around 5% up here. And almost killed the real estate market. So I'm sure you remember that between the fourth quarter of 18 and the first quarter of 2019, it was dead, right? There was nothing going on because rates had spiked up so much over here. Rates had spiked up so much. What happened is inventory doubled almost instantly because people thought it was the end of the recovery. So rates went up. People thought we were done. Let's just stop buying and selling houses because rates are crazy. Now, I got back in the business in the mid 90s and I can remember 9%, 10%, 11%, like those stories you'd hear from your grandparents. I remember when it was 18%, So really when you think about it, 5% is not horrible, but compared to what we were used to, we thought the recovery was over. And then look what happened after that. All right, so going forward, what's it projected to be? And Mo, I hear a little bit of echo. I don't know how to get rid of it.
Uh-oh.
I'm going to let you be the IT person on that one.
Okay, you got it.
Okay. All right. All right, so let's take a look in here. So when we look at projections from Freddie Mac, Fannie Mae, MBA, and National Association of Realtors, Mortgage Bankers Association, for those of you who don't know that one, and then NAR is National Association of Realtors. And then you average out those four. When you look at where they expect rates to go, they're all right on, right? They're all looking at the same data. So they're all right on. So anywhere from 3.52 in second quarter this year, third quarter this year, 3.52. End of this year, 3.57, and then going into next year, 3.47. So I think rates are a very shining star in all of this, where they are expected to stay low for quite some time. All right, the next slide, let's talk about, this chart shows the volatility of interest rates recently, and you can see what you can expect going into 2020. It goes flat and it stays flat. After a crisis, everyone wants this kind of stability, predictability. So this is a great thing for us, that the rates are projected to stay at that level and then continue. That's very good. People like to know what's going on, right? There's been enough uncertainty going on. Having something that's certain is a very positive, good thing for us. So the Fed is injecting money to make sure that we have predictable rates for quite some time. I've heard people say 1 year, 2 year. I've heard some people say 3 to 4 years. I don't know how we could even possibly project what's going to happen 3-4 years from now at this moment in time, but it definitely is for the near foreseeable future. They're buying mortgage-backed securities, MBSs, at a pace to keep this predictable. They're buying it, they're injecting money, they're controlling it so the rates can stay this low. So this will help the housing market recover. So instead of being our fault like it was before, the mortgage world, the financial world, the real estate world, we're actually going to be able to be helpful and hopefully help get us out of this. So when you hear the Fed drop the rate to 0, one thing I want to talk about, Mo, people say, well, the Fed rate's at 0. Why aren't we at 0? Why aren't we negative? So when you hear the Fed drop the rate to 0, that's not the mortgage rate. There is a relationship between the two. One impacts obviously the other, but mortgage rates are not. Mortgage rates are tied to the 10-year so much more than they are what the Fed fund rate is. So what drives people into buying mortgage-backed securities is they feel it's a very safe investment and a very safe place to put their money. Think pension funds, think insurance funds, think a lot of giant investors with billions of dollars out there. They want safe, secure money. They put that in the MBSs, mortgage-backed securities. So right now, because the Fed is going heavy hand in this, and they're going to purchase mortgage-backed securities, we know this is going to be a very stable environment for the near foreseeable future, which is how they're able to predict that rates are going to stay this low for such a long time. Make sense?
Yes. Oh, yeah. Perfect.
And you're magical because you got rid of that echo. So thank you for that.
Yeah. All right.
All right. So my last section that I have is let's talk about the good news of this after this crisis, or the good news, that we should see, I think, starting going forward. So largest population groups of homeownership age. Mo, you've heard me talk about this. You've heard me talk about the baby boomers that were up here that were the largest generation. You've heard me talk about the millennials, the, 2-3 generations down, that is even larger in population size than the baby boomer is. So you've got those two groups buying houses. So you have more people that want to buy a house than you have houses for the people to buy.
That's
so
right.
We have the, yep. So that's that demand, right? So we have the largest population groups that are all of homeownership age. We have that pent up demand, right? Rents continue to rise. So for all of you who are landlords, rents are just going up, right? They're not coming down. Even during this, they're going up, right? That's crazy. And then we have historically low inventory. So to our conversation that we had, I want to say 3-4 weeks ago, the supply and demand. If you guys want to go back and listen to that, I'm sure Mo can give you instructions on how to access it. But that supply and demand conversation that we had, right? We still have such low supply for such high demand. We're still kind of out of whack on that. All right, so then let's look at this one, and we have to digest this chart. Anytime I have a chart, and you guys by now, if you've been listening to us for the past 10 weeks, right, Mo? They know that I'm a total dork and I love all my graphs and charts. I don't care.
Well,
it's
they've seen
okay.
us both, so they know that already too, right?
Right. They know that we're both complete dorks.
Anyway.
Right. Complete dorks. All right. So strong demand. So let's talk
about. Did I lose you?
Oh, can you hear me?
I can't hear you.
Really? Where'd you go? Can you hear me now?
Mike.
No, I'm right here. Can you hear me?
Uh-oh.
I didn't do anything. Can anybody else hear us?
Oh, there you go. Go ahead.
Okay. All right. No, it's just you. You're special. All right. So let's take a look at this chart. So the homes that are going to suffer a little bit right now are the ones that are 2 times the median price, right? So 2 times the median price is going to suffer a little more. Anything that's 1.5 the median price or down should continue to move quickly due to the low inventory. And median price obviously is going to vary from market to market, right? What's the average price? What's the median price? They're not exactly the same thing. For all the other geeks out there, we all know that average and median are not quite exactly the same. That's right. So the homes that are 1.5 times or 2.5 times above are going to stay on the market a little bit longer. But again, we still have such low inventory. You know, I live out in a rural area. Say that fast 10 times. Yeah. I live out in a rural area, and in my rural area, it would take, you know, if the house was 350 or high, 350,000 or higher, it would take 4 to 6 months for it to sell if it was going to sell, right? Whereas if you took that same house and you plopped it in the city somewhere, that would have sold within a month or so, right? So it definitely takes a little longer. I can tell you that those houses are still going at a faster clip than what they have in the past. So taking a little longer, but still selling, right?
Yeah.
So when we take a look at this chart, we can see where we were before the housing crash. We had way too much inventory, right? Way too much inventory. The highest inventory we had ever had, which was then the potential for the crash. So now we're at less than half that amount of inventory. This is the lowest inventory that we've had in history. So think about that. We're at the lowest inventory we've had in history, and we have the largest population sizes of people trying to buy a house. Jeez. Think about that. That's our supply and demand conversation, right? So housing is not exempt from the supply and demand. It's right in the middle, right in the game, right? Supply and demand. So if we don't have supply and we have good demand, then we'll continue to see the price appreciation. So the question then is there still going to be demand? I don't see how there's not, right?
That's right. There is. It's still there.
Right. Yeah. I mean, the baby boomers are still there buying houses. The millennials are of housing formation, is what we in the geeky world call that. They're forming households, right? They're in housing formation. So they're now the millennials, they met their wife or partner later. They started having babies later. You typically buy a house when one of those life things happens, right? So they started doing that 3 to 5 years later than the previous generation to them. So they're a little later down the path, but they now are in that age group where that's what they're doing. Household formation is what we call that. All right, last 2 slides. I have a bunch of geeky numbers for you. You ready?
Yes.
All right, so we all know that I love GDP and to talk about GDP, right? So gross domestic product. So let's take a look at what the GDP did in quarter Q1, Q2, Q3, Q4 just of this year. So we know Q1 is down, and it was only down because of March, not because of January or February. January, February was off the races, right? So we know it was down because of March. Take a look at Q2. We think it's going to be down. To me, that's 12.9 to me is 13%. I'm a rounder. And then Q3, and I'm going to say only down 2%, right? Only is great when you're at 13 and you go to 2, negative, still negative. I got it. Negative 13 to negative 2. To me, that's still a silver lining. But look what happens by the end of the year. We're positive 5%. And then into next year, we're positive 8.8, 5.9. It's all positive, positive. Take a look at real estate residential investment, right? So Q1.
Let me ask you something.
Yes.
Can we go back for a second? Where do you think they're basing off of this? Off of the difference that you and I talked about? Where is this data based off of? We were talking about based on. I mean, we're doing a quick review here, real quick for Q1, Q2, Q3. So we're projecting this because of what? Because of our pent up demand, right? That's where we're seeing it.
Well, this in general is just GDP. This is just overall national GDP. So we know that our economy, which is measured by GDP, right? We know it was going to be a total of negative for Q1. January, February positive, but March was so bad that we know it brought everything down, right? We know because of the unemployment, because people aren't spending. Remember, 70% of this GDP number is consumer spending, right? Consumers are staying at home. They're not spending money. They're not traveling. They're not living life the way they normally live life, right? Small businesses make up, I think the chart was 18%, 11, 12% with small businesses. How many small businesses right now aren't doing business? If they're not doing business, they're not paying taxes. 10, 11%, something, don't quote me on that, was government. Government right now is on one hand booming, but on the other hand suffering. The local municipalities are suffering. They're not getting all their tax revenue in, right? So GDP, this number up here in the yellow, it really is the overall economic measure, right? This is the whole thing of GDP. And this is from the MBA. They're forecasting, as well as others, and we've looked at those charts before. Goldman Sachs, JP Morgan, other people will estimate what the economic forecast is. So this is just the economic forecast for GDP from the Mortgage Bankers Association, and it's negative, really bad negative, a little less negatives, but by the end of the year, we're still back in the positive. Right.
I mean, now look at that. I
and
mean,
look at next year.
Residential investments as well, as you highlighted there in circle. My gosh, look at that.
So look at that. So we're negative. Okay, so we're not selling houses. We're not doing much right now like we normally would.
Right.
And next quarter, it doesn't look like, according to the MBA, who's smarter than I am, we're not going to be doing any different than the second quarter. Second and third quarter are both negative. But we pop right back into positives by Q4 of this year. And then look where we go next year. It kind of takes off to the races in Q1, and then we have a great year, right?
Yes.
All right, so let me read my notes. Let's make sure I didn't miss anything. So we know the GDP is going down, but you can see that we've really been consistent and around that 2%. So goal of GDP is between 2 and 3%. So when you get into the end of this year and into next year, we're way above goal. So it's going to drop off in Q1 because of March and April. Then you look at Q2, we see a huge drop, but then we see that recovery in Q3 and Q4 of just this year. And then look how consistent we are going from there on out. So notice that we're talking about duration and how painful, but we're only talking about a 3-month recession, 6 months recession. That's not years of recession, right? It is painful. But if it's painful for a much shorter time period, I'm okay with that versus painful for a lot longer, right? We don't want 3, 4, 5 years. All right, so then let's look at real estate specific. That's our next chart. And that's my last chart that I have for you guys today. All my geekiness will be over for the day. All right, so let's look at MBA's forecast, mortgage forecast from April 2nd of 2020. So when we look at housing starts, and remember housing start is new construction, right? New construction is 10+% of our total inventory. So when we take a look at housing starts, they were at 1,428, and this is in thousands, obviously. And then it went down to 1,000, down to almost 1,000, and then back up in Q4. So the conversations that I hear on my National Association of Home Builders call is that builders are still acquiring land. Well, acquiring land is the first step in the process, right? You have to have the land, then you have to go apply for your permits, which is what this is, and then you have to actually start construction. Right? So they got to go buy the land first. So they they had stopped buying land for a couple months, but now they're already starting to talk about, hey, I need more land. Hey, I need more land. Hey, do you have land? Hey, is it at a good price? I'll buy it if it's at a good price. So hearing those conversations start back up, that's positive news, right? And then when you look into
the beautiful thing, we're talking about that in several masterminds and calls that I'm on and other groups. And the conversation is, okay, what opportunities are we looking at, right? There's a lot that are hitting the market with retail, right? Even though retail has taken a big hit right now, but there's a lot of repurposing that I'm hearing. A lot of the old other, places that were once restaurants are now turning into, something like a more of a commercial administrative type office. There's some movements and restructuring happening, but it's all for the good as far as repurposing and reuse. So that's good.
And it's use of some sort. I don't care what it is. We're using it. That's a positive thing.
Right.
It's not just sitting there. It's not sitting there vacant, empty. It's not being foreclosed on. We're repurposing it for a more efficient use, but it's still doing something, right? There's still activity going on. All right. So as we can see, housing starts for the rest of the year. We're going to take a dip down, but then you can see they pick back up and they're pretty consistent. Take a look at this number for home sales. So this is our retail. This is our existing, not retail. This is our existing home sales, right? So we took a dip in Q2, just like we know we did. We come back already in Q3, and we come back to Q4 more so than we were in Q1 of this year. Now, remember, Q1 of this year, we had March was our drag down, right? But look, we end the year like we started the year. That's a very positive thing. And then look at next year, it just consistently takes off. Yeah, next year. Now, double down with that in the interest rates. Interest rates are consistent. Under 4% for the near foreseeable future. And if the Fed comes and starts playing with this yield curve control mechanism that I've just in the last week or two started hearing about, we might see rates lower than what these projections are right here. All right, so let me just check my notes. We covered that. But the beautiful thing is looking at Q4 this year and Q1 next year is good looking. Look at those rates. Yep, those are my notes.
All right.
So as I kind of conclude for my time, and as we kind of not necessarily recap, but I really do want to stress to everyone, this is a great time. Then something horrible is happening, right? But we're in a great industry. We're going to recover faster. It's not going to be this long draw. I mean, it will be for some people, don't get me wrong. But this is a great time for you to get your mindset ready, set your expectations properly, do all your planning and get ready, because as you can see, when we start to come out of this in the mortgage and real estate industry, I think we're going to do really well. So be ready, get your mind ready.
Beautiful.
And that is all I have today.
And I think the biggest thing that we're all trying to get ready for is not just what's coming. It's also about what we're focusing on, because a lot of us as investors in the past, Lindy, what I've done before is we've lost focus of what am I going to buy? What am I really, looking at investing in? And, there's a lot of things that are happening right now. Let's take a look at for instance, just an idea. Right now, merchant sales are through the roof, right? What are they talking? Above 200 and some odd percent increases that have just occurred here massively. And I think we're going to see a lot more and more of that. So investing in some of those opportunities, and they're actually, e-commerce is coming back around and taking a big jump with online sales the way that they are, right? So storage and manufacturing are starting to come back in for some of those items that are widely used. So paying attention right now for where the trends are and where the market changes are is really important. Researching that, but then again, looking at what are the drivers, what are the industries that are getting us out of this, and where is the recovery really going to happen the fastest? And that's where I think we have to take a look at and support and invest in.
Right. Had we had any idea about Zoom, we'd all be rich by now, right?
Right, exactly.
If we got stock in Zoom, we're like, had I known, that would have been awesome, right? Yeah.
Trust me, I'm watching that stock go up and up and up on all my apps. It's crazy.
Well, and think about, I am surprised that online retail sales is doing as well as it is. So that tells you people aren't going to the stores, but they're still spending money. They still have a habit of spending, right? So they're not doing it in the store. I mean, grocery sales are up naturally, right? But think about that. I mean, retail sales, I was surprised that it wasn't a much worse number than it was. It's got to be the online sales component of it.
It is.
People are still spending money. I mean, I can tell you, Lowe's and Home Depot, last time I went to Home Depot to pick up something, I had to wait in line outside just to get in the building. I thought, you've got to be kidding me. And when I came out, the line was just as long as when I went in. So consistent all day long customers, right?
That's right. Well, we're going to talk about that, and I'm going to actually start bringing in some other investment opportunities as we look at this and as we are transitioning out and going into recovery. So some of the folks that we're going to be inviting and bringing onto the show are different things that we're looking at and measuring are the ones that are driving and getting us out of this, otherwise, and which ones are the trends that we're focusing on as investors, or creative other alternative investments, right? Like we're talking about with merchant accounts and merchant services and things like that that are running right now. That's one that I'm hoping to have on a call with a guest speaker coming up soon. So stay tuned and don't miss it.
Good.
Well, thank you, ma'am, for a wonderful, awesome presentation here this week. And our market update just gets better and better. And it's really helpful for us to have the data that we have this week and understanding the similarities of these different recessions and where we're currently at and where we were at in 08, right? So thank you so much for bringing those similarities up to date here for us. And hopefully with week 12, we'll have a much better number coming soon, right?
Yeah. But like Mo and I have said, I think repeatedly throughout this call, any of you guys that are listening, if you have comments, you have questions, we can always cover a topic. If you guys send us comments and questions and it's something that you want us to cover in a future topic, we can absolutely do that. So you guys let us know what you like and what you don't like.
What information are you looking at? What's the focus right now? What research do you want done that helps out for where you're looking to be and where you want? So definitely
don't maybe do too much research.
And without further ado, I want to make sure that they have your contact information, Lindy. Here, there we go. Your phone number and email right there. Thank you so much. And I want to make sure, please reach out to us, reach out to Lindy, and give me a call, send me an email, let me know what content you're looking for. If you have deals you want to present next week, please make sure you look at the link and you'll be able to do so. For now, thank you for joining us this week, and we'll see you next week.
Thanks, guys. Bye.
Bye-bye.